Welcome to Financial Strategies with Andrew Agemy in Connecticut and Daniel Agemy in Colorado.
So, they asked me, when can I get tax-free income? And the idea is, when is $1,000 not $1,000? Well, when you have to pay tax on it. And if you have it coming out, $1,000 coming out of your account on a tax-free basis, then that's $1,000 that you can actually spend and not affect your taxes. I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. Today we're talking about if it's tax-free, it's for me. And AAA, I think taxes may be one of those things that is underestimated in a retirement or just investing
in general. All right. Right.
Fees is one of the things that's not talked about enough.
Right.
Either they're low fees and you're not getting anything, or they're high fees and you could be doing better. And taxes is the same way. There's a lot of things people may have never heard about that we're going to talk about today. Mm-hmm. And there's a lot of things that people probably can just tune up. So today I think is going to be a pretty practical show for most people.
Right. And nobody wants to pay, well, I shouldn't say nobody, but most people don't want to pay more taxes than is their fair share. And that's what it's about, right? There's a Supreme Court judge in the 60s that said it's every American's right and duty to pay as little taxes as legally possible. So that's what we're talking about today. It's not about what you make that counts as much as what you get to keep. And so if you have money that's tax-free, well, then you get to keep more of your money. And it's a beautiful thing. And unfortunately, most baby boomers have not been able to take advantage of the tax-free nature on things as much as maybe younger people have. I know, Daniel, you have a lot of tax-free accounts and, your brothers and such. But, a lot of baby boomers, they didn't have that advantage because they didn't make that available to them. Like, for instance, Roth IRAs did not become a thing, was not even available until somewhere around 1998, 1999 or so. So most people did not put in them. Then when they became available, they were such a little amount. People didn't put in them. It's just kind of crazy, right? But it's important to be able to understand taxes. And Daniel, you're right. Taxes are so misunderstood in so many ways, right? So many times when taxes are done, what people do at tax time is that's when they think about taxes. But in actuality, it's kind of like too late to do any tax planning for the previous year because you're already in the new year and the die has been cast. And all you can do at that point is damage control. And that's why it's so important to be able to have a company, like we have Connecticut Sound Tax Group, to do tax planning for people as well as tax preparation. It's usually when people are doing tax prep, all they're doing is counting the beans, so to speak. And they say, well, we'll talk about planning later, then they never get around to it, right? And a lot of people that prepare taxes don't know about tax planning. So that's a big thing. Most people, and even CPAs, a lot of people think, oh, CPAs know all about taxes. No, we have a client who was a corporate CPA that knew nothing about taxes. Had a CPA, but the CPA stands for Certified Public Accountant, bean counter, so to speak, affectionately for those of you who are CPAs. But, whether or not you specialize in taxes, that's a whole nother thing. That's where the enrolled agent with the IRS comes into play and some other things. But nevertheless, it's important to be able to understand taxes so that you don't have to pay more than your fair share. And in order to do that, when it comes to investing, we start with the concept of tax diversification. We know about investment diversification, so much in stocks, so much in bonds, so much in commodities, so much in cash. But what about tax diversification? Tax diversification comes into play with there's pre-tax, which most people have a lot of money pre-tax because it's their 401ks and IRAs and things. Then there's after-tax money. Maybe it's just a brokerage account that you have, a bank account that you have. That's after tax. You're going to pay tax on anything you make. Tax-free, where you're not going to pay tax on anything coming out. Tax deferred, where you're not paying tax as it's growing, but you'll pay taxes on the interest on the growth when you take it out. All these different kinds of things. And the whole idea behind, the tax deferral nature, the 401ks, IRAs, that kind of thing is, to me, part of a lie that was instituted that said in retirement, you'll be in a lower tax bracket. Well, some people are in a lower tax bracket when they retire, but most people that I come in contact with are either in the same tax bracket or a higher tax bracket. So that's why I call it the lie. And so that's why it's important to be cognizant on what's happening with the taxation on your investments and how you can deal with that to make them grow. And Daniel, there's even on after-tax investments, there's a way that if it's managed properly, right, that people can save some good money on after-tax investments, right?
Right. There's a lot of strategies that you can use with the investments to make it more tax efficient. Yeah, and I guess a good example would be if you had $200,000 in an after-tax account, you put it in something you're earning 5% on. It's $10,000 a year, right?
Okay. Right. Yeah.
You're probably going to pay around $2,500 of that in taxes, which means you only net it. Now, some people are going to be higher. Maybe some people are going to be lower. Probably not too much lower, but right around there, right? When you talk about state taxes and federal taxes and everything. Yep. Now, if you were able to get that into a Roth, for example, you get to keep all $10,000. That's huge, but it's nothing compared if you talk about that compounding over 10 years. Because without compounding, just simple interest, that'd be $25,000 difference, right? $25,000 difference. And that's not assuming taxes go up.
Right. Right.
So these are big, these are little steps that can make big differences. And somebody will say, well, how could I get $200,000 into a Roth? Well, as we go through the show, we'll give some good ways where people actually can get that kind of money into a Roth, depending on your situation. But you can definitely do it in a lot shorter period of time than you're thinking for certain people.
Right. You listen to Financial Strategies with Andrew Daniel Agemy. Today's topic is tax-free retirement. If it's tax-free, it's for me. And we're glad that you joined us. We're talking about how to be able to get and have tax-free income in retirement. We have a paper that we'd love to give you. That's called What You Need to Know About Roth Conversions in 2024. We're going to talk about Roth conversions today. And this paper will help you be able to understand the basics of that and how that works. And there's a lot more coming at you. So call for your free copy. What you need to know about Roth conversions in 2024. 800-725-7616. 800-725-7616. Today's topic is, if it's tax-free, it's for me, tax-free retirement. Daniel, that's a great thing that you're talking about there with those things. And, the compounding of tax-free is phenomenal. You just said, over a 10-year period of time, you're paying $25,000 in taxes, right? Well, I said it the other way around. I said you had $25,000 in an account that you wouldn't have. Oh, okay. Without any interest. Tax-free. Yeah. But it works either way. Yeah. But my point being is, right, if the compounding, if you're paying that in taxes, it's going to compound, like you say, it's going to go up. Many times the accounts, once you hit required minimum distribution age, you have to start taking money out every year. The percentage you have to take out goes up every year. So you got the compounding of that, and then the taxes on top of that, and this compounding nature that happens with what you're going to be paying in taxes, versus if you pay the tax earlier on, pay it while taxes are on sale. Then you'll be able to actually compound it within your portfolio so that it can work harder and be better for you later. Very cool thing. So compounding happens not just with the investments, but compounding can happen, on the taxes, which is to your negative, but also if you had that tax-free, it would be to your positive. Well, as we look at this and talk about the lie that says take it out on, when you're in the lower tax bracket, one of the ways to be able to mitigate that is by, first of all, contributing to a Roth. There's a lot of people out there that don't contribute to Roth. Why don't they? Number one, they don't know about it. Number two, maybe their income is so high that they don't qualify to be able to contribute to a Roth. But there's ways around that. And sometimes it's a no-brainer because people will have money in a non-qualified, a non-IRA account, an after-tax account that they can just take the money. If they're over 50 years old, they can take $8,000 in 2024 and put it into a Roth IRA for 2024 per person. But if you're, there's certain rules that go along with that. If you're over a certain income, that could be a problem. Right, Daniel?
Yeah. Yeah, there's some different rules. I think maybe we should take a step back. You said pre-tax, after, tax-free, and tax-deferred, but maybe take a step back and explain what those things are.
Okay. So a very good point, because I did go over that quickly. So pre-tax is your 401k and IRAs. You put the money in pre-tax, before tax. You didn't pay tax on it as you put it in, with the idea that you'll pay tax later when you take it out, when you're in retirement. And that's where the lie comes in. Oh, you'll be in a lower tax bracket, right? So
you get money in there. You get money in there. It's compounding. Yeah.
Growing.
From our example earlier, that $25,000 is in there, right? That you didn't have to pay tax on, but you're going to pay tax on that at some point in time. But you have another $25,000 that's growing for you, growing and compounding. But you're going to pay tax at it at some point.
Right. And the idea is it's growing faster because it's a bigger number. And, back in the old days when IRAs came out, the government said put $2,000 into retirement, into this IRA. You won't pay tax on it, which back in the 70s when that came out, that was a big deal, $2,000. When people were making $12,000 a year, $14,000 a year, being a good income, well, $2,000 was a good amount. And then you don't have to pay tax on that, and you'll pay tax later, and it will grow. And that $2,000 today, maybe that's worth, $20,000 or $25,000 or $30,000 or $40,000 today. But you're going to pay tax at this point should you take it out, or when it comes out, whether you die and it comes out or you need it for retirement. So that's the idea of pre-tax. You put it in, you get the tax benefit up front, and then you pay taxes later at whatever your rate is at that time. Well, I see it's time for us to take a break. And you're listening to Financial Strategies with Daniel Agemy. Today's topic is tax-free. It's for me, tax-free retirement. And we have a book we'd like to give you that goes along with today's show to be able to help you understand how to have a strategic movement around retirement taxation. Smart Retirement is what this book is called. And it's an easy read book. And it's one of several ways how you can be able to have tax-free income during retirement, or just tax-free money, so that if you want to, if you want $100,000 to go on a trip, you can use it, and it won't affect your taxes. So we'd love to give you this book. You can call 800-725-7616. First 5 first-time callers, 800-725-7616 for your free copy of Smart Retirement, to be able to how you can move around and have tax-free income later on in your life. Call now.
Do you have any questions for me about retirement income source?
I just want to make sure I can invest well enough to have enough income, enjoy my retirement.
We build a custom retirement plan based around your income and goals.
How do I know I can trust you?
Building trust does take time, but our investment advisory arm is comprised of fiduciaries, which means our obligation is to you, so you can enjoy your retirement with a little more income stability.
I'm in.
That's 2 out of 3.
This is Financial Strategies with Andrew and Daniel Agemy.
I was talking to Johnny the other day, and Johnny and Ramona were talking about how they need to do $60,000 of repairs to their house. And Johnny says, I'm going to retire next year, Andrew. I'm just going to take it out of my 401k, and I'm going to take that $60,000 out. Then we'll do the $60,000 of repairs to the house. And, and we'll just use that money. It'll be nice and simple. I said, Johnny, don't do that. First of all, if you take 60 grand out of your 401k, you're only going to end up with maybe 45 grand. And it's going to put you in another tax bracket. Oh, that's going to hurt you so tremendously. But you have this tax-free account here that we can take the money out, and we can take out the 60 grand, take it out, and then you'll be able to take care of your house, and then we'll put it in little by little. We'll pay it back to yourself from your 401k monies. Johnny said, Andrew, that's a phenomenal idea. Why didn't you tell me that earlier? I said, I did, Johnny. I'm Andrew Agemy.
And I'm Daniel Agemy. And you're listening to Financial Strategies. Today we're talking about if it's tax-free, it's for me. Yeah, and AAA, that happens all the time. Sometimes people don't take the advice and they pay ungodly amounts of money in taxes, and it eats us up. And they don't consider they're not compounding. Not only did they pay all that taxes, but they took the money from this spot and it's not compounding anymore. So that's 7% a year, whatever is compounding, that you will never recover. And so at least Johnny listened, and he's going to be going forward. Yeah.
Right. Or, I'm thinking of another client that just called up and, he wanted to take it out of his IRA, and it's like he's got all of this taxed money already, and he wanted to take it out of the IRA to pay taxes on it. It's like, no, don't do that. Right. So, that's the thing, that people don't understand taxes and how they affect things. And unfortunately, Daniel, there's a lot of financial advisors that don't understand taxes. That's why they'll say, oh, you got to talk to your tax guy. What do you mean? That's terrible. That's terrible advice. They should be able to help you. And the right fiduciary of a financial advisor is going to be able to help people with their taxes to be able to pay less taxes. So, we finished up that first section, Daniel, talking about pre-tax money and the tax benefits that you get on that are on the front side. And, then there's after-tax money where it's just like when people are putting money into the bank or into the brokerage account, they get paid. Oh, I've got $1,000 more than I need this month, so I'm going to put it in this account. And then over time, that builds up, and they're not going to pay tax on that money they put in, but they're going to pay tax on the growth of that money when it comes out. But the account is an after-tax account, and depending upon how it's invested and so forth, maybe they're paying tax every year. So every year they start over, maybe, as far as paying tax on just that year. It all depends, right? But that's the idea of an after-tax account. Then there's
these are like bank accounts, right?
Yeah.
People have brokerage accounts too, but typically when we're thinking about that, it's a bank account where you put your money in, you hope you earn some kind of interest on it. The difficulty comes in when it starts being a large amount of money in there and you're paying a lot of taxes. If there's not a ton of money in there, it doesn't really affect you on the taxes. But once it starts building up, which people will do, and everyone doesn't understand that there are these options where you can put it into some of these other types of accounts that either you will never pay tax on it or at least can be deferred. And so you can compound on the money that would be going to the government for taxes.
Right. So, I'm thinking of an account I saw recently with, $1.4 million sitting in cash, not making anything, which is terrible, right? Because they should be making, like $70,000 just at 5% interest. But that $70,000 would be fully taxable every year. But still, they'd pay the tax, and they still end up with more than what they're getting just having it in cash, right?
Right.
But that's
some of these tax advantaged investments you can put in there. You can get either very little taxes, but if you want to earn some good money, you can still earn, like what you said, that $70,000 a year off of it. Actually, you could probably do more than that, but conservatively, $70,000 a year on that.
Right, conservatively,
and it's not tax. It's tax cheaper than interest.
Right.
So your tax, the interest would be at your normal income bracket. This would be a lower than your normal tax bracket, which is a pretty awesome feature that's available for that.
Right. So, you could be making $85,000 and be, instead of 70 on that 1.4 million, and potentially paying less taxes than you would be at the $70,000.
Yeah.
So that's a great thing, but you need to know how to do that, and you need somebody that's going to do that for you. And that's why your financial advisor needs to have some tax advice or training to be able to be the right to do that for you. But that's the idea of after tax. And then there's tax free, which, if it's tax free, it's for me, which is the idea of where you'll never pay tax. It's kind of where, I said to Johnny at the beginning of the program, right? It talking to him about how he has this tax free account. He can take money out. He can put the money back in, and he can, use it and put it back and all these different kinds of things. It's a beautiful thing to have that tax-free account from that standpoint. And then Roths are similar to that, where you know, when you make money, you put the money into the Roth and then you don't pay tax ever again on that money. All the growth is tax-free, which is a beautiful thing. But again, like I said earlier, baby boomers, a lot of them haven't taken advantage of that in a great extent. And so now they're taking advantage of it by doing Roth conversions, converting IRA money to Roths as opposed to doing contributions. And then we're also trying to get them to do contributions now once they become our clients so they can have it. But the problem with those accounts are if you take the money out, you can't put it back.
Right.
And that's why I like that first tax-free account. That's what the book is talking about, that we have Smart Retirement that we're giving away today, is how you can take it out and you can put it back. You know, it be your own banker kind of thing. So that's a beautiful thing. But I want to let you know that you're listening to Financial Strategies with Daniel Agemy. Today's topic is, if it's tax-free, it's for me. And it's all about how to be able to get to pay as least amount of taxes as possible. And we have a paper that we have to go along with today's show. And this paper is called How to Give and Receive Charitable Contributions, because this paper is designed to be able to help you to be able to pay no tax on money that you're giving away and actually pay lesser tax on Medicare and some of the other things because of how the money is being given to charitable organizations. So if you give much of anything to charitable organizations, your church or college that you went to, any of those kinds of alma mater, this paper will be good for you. You can have it for free by calling 800-725-7616, 800-725-7616. Call now for your free copy. Well, when we're talking about all these different tax advantage things, we just talked about tax-free, we talked about pre-tax, after tax-free, and then there's tax-deferred, where you're not paying taxes. So in that example earlier that we talked about, that 1.4 million, if they're making 5%, 6% tax deferred, they're making $80,000 a year and not paying any taxes on it until they take it out. So now that's a beautiful thing, because, you know, they don't have those taxes. If they need the money and they take it out at that point, then they'll pay the taxes on the growth at that point. But if they don't need it, they're not paying taxes. So it's a great strategy that we use at Connecticut Sound Tax Group, our tax company, when we're looking at people's and doing tax planning for people. It's one of the first things we see. How much are they paying in interest and dividends and that kind of thing? And if they're having, you know, tens of thousands of dollars that they're being taxed at, we look at that and see, well, is this a piece for at least some of that money so they don't get taxed? And people typically like that idea.
And then so those are the different buckets of money. And usually people all have some version of those. Maybe everyone doesn't have all of them, but somebody has some of them, right?
Right.
And so this is where you, as an individual, have different needs, different goals. And so there's a combination. And this can change, this can fluctuate, and it should change and fluctuate depending on your situation, depending on what you're putting money into, depending what you're taking money out of, like AAA mentioned earlier, and depending what your goals are. Some of the tax deferred stuff, as you mentioned, this is like Warren Buffett is a master at this, right? He's deferring all his taxes and he's going to die and it's going to pass on tax-free to his heirs. Right? Maybe you would say it's a little bit of a miser. Maybe you'd say it's genius. No matter how you look at it, that's how that is. If you're charity minded, it makes a ton of sense that you put the money into your tax deferred buckets or the pre-tax buckets, right? The IRAs, the traditional 401ks. You pack that in because it's benefiting you now. You're getting the deductions now, especially if you're a high earner. And then you can take that out tax-free and send it to these causes that you want. And I shouldn't even say you're taking it out, because it's not really taking it out. It's having the IRA send the money to the causes that you care about. That's a really, especially if you're working and you can put money into the 401k and pack money away that way, that's a really cool way of benefiting a cause that you care about and never having to pay the taxes on it.
Nice. Yeah. It's a beautiful thing, you know, how you can manage your money in a way that is going to help you pay lesser taxes. And I would just want to bring that across to people. That's a huge thing. And one of those things, you know, we mentioned it, you know, doing a Roth conversion or taking money from your after-tax account and contributing to a Roth IRA is a good way. There's things that are called, backdoor Roths that are a legal way. It's a legal loophole currently in the legal system that allows people to put money in if they're a high wage earner and they don't qualify to contribute to a Roth. This is a way that they can still get money into a Roth legally. There's the rich man's Roth that is available, and that's what the book is talking about today. Is for those people that make too much money, they can put whatever they want into this rich man's Roth and it can come out tax free. But if you're converting money, you're going to have to pay taxes on that money when it's converted. And the significant thing about that is that currently taxes are on sale. If you're married, taxes on sale, and just in the legal system, taxes are on sale right now because in 2026, the tax rates are going to be going up. They're scheduled to go up under current law. But also, if you're married, your taxes are on sale because when one of you passes away, the survivor is going to be in a higher tax bracket. Going to go from married filing jointly to single, and that will be a higher tax bracket. So as much as you can get converted into a Roth sooner rather than later, that's a good thing. But we don't do this a lot of times for clients who are not yet retired and making a high wage. We wait until they retire and then we do it. And we do what's called bump in the bracket. We take you up to the certain bracket, and make sure that we take, if there's $30,000, $40,000 within that bracket, that we can convert without pushing in the next bracket, without you paying too much on IRMA taxes for Medicare. We look at doing that, have you pay the taxes on that, and taking the money from an after-tax account to pay the taxes, and that's a beautiful thing. So there's contributions and there's conversions. Right to Roth IRAs. And this is what we're talking about with the conversion from that standpoint. So there's a lot more to come on that. I see it's time for us to take a break. And you listen to Financial Strategies with Andrew and Daniel Agemy. Today's topic is, if it's tax-free, it's for me, being able to have tax-free retirement. And we have a book that goes along with that called Smart Retirement by Matt Segula. It's a simple read book, about 100 pages. And love to be able to put that in your hand, to be able to give you some ideas that work for some people. 800-725-7616, 800-725-7616. To the next 5 first-time callers, call now.
Financial Strategies with Andrew and Daniel Agemy.
I was talking to somebody the other day, and they had just sold a piece of real estate. And I told them, we can put that money in your Roth, your 401k Roth. And she said, how can we put that in the Roth? Because when you take the investment proceeds from the real estate and you invest it, you got to pay taxes on whatever you're earning, right? It's nice you're making money, but you got to pay taxes on that money. So I said, we can put that into your Roth 401k. And she's like, how do we do this? And I said, well, my dad taught me this trick back in the day, and we can make it work. I'm Daniel Agemy.
And I'm Andrew Agemy. Listen to Financial Strategies. And Andrew, Daniel Agemy. Today's topic is, if it's tax-free, it's for me, tax-free retirement. And because people don't know what people don't know, and there's a lot of things that we're talking about. So that's great, Daniel. And I just love being able to help people save money on taxes. I don't want anybody paying more taxes than what they have to, legally speaking. And so this Roth IRA is a great thing. If you're able to make contributions to it, that's great, but it goes in a little bit slower that way. If we convert, we can get a lot more in faster. That's great. So, the one thing that people will say, oh, yeah, but isn't there a 5-year rule where I can't take it out for 5 years if I don't have an IRA? Well, if you've had an IRA for 5 years, that doesn't apply. And the 5-year rule actually deals with a penalty on the growth if you take out the growth. If you take out the principal within that 5 years, you're okay. But the penalty and the 5-year rule on that. So it's really like of not very much significance to most people. So tax-free growth instead of tax-deferred growth is a beautiful thing for people. Do you agree, Daniel?
Yeah. I thought you would want to hear how you get the proceeds from a house and do it on.
Well, I wasn't going to take that bait. That's what that was. If you didn't want to tell me, I didn't want to ask. Okay, so how do we do it, Daniel?
So that is one of the amazing things about income too, right? So you take 500,000, whatever you get from the proceeds of the house, and you turn that into income. Now you're gonna have to pay taxes on that income, right? So call it $25,000 to $30,000 you could generate from that in income. And a lot of real estate people are starting to realize this, that they can get more in income from selling the property at prices now and investing it in bonds and bond-like instruments, right? The universe of income-generating instruments for less work, less HOA fees, less taxes, right? And get more income. So a lot of real estate people are realizing this and they're flipping strategies. But you got a pile of $500,000 now sitting there. So you can really get up to right around $69,000 into there. Most people, it depends on what their employer will let them do it. But if you're over 50, you can do $30,500. So you take the income, the $30,000 you're generating from income, and you spend that. Mm-hmm. And you take $30,000 from your paycheck, and you put that and max out your Roth 401k. Mm-hmm. And you're taking the proceeds. The only problem is you're not actually taking the proceeds because you're generating so much income that your 500 is staying intact, but you're still getting the 30,000 into the Roth. So you're making all of that tax free. And now that's compounding. The 69 comes in where if your employee, you can call the employer, you can call the plan, and you can ask them, either the employer can do a profit sharing to get you from the 30,500 up to the 69, or sometimes the company will let you do the employer contribution and you pack that into there. It's usually into the traditional, not the tax-free, but you could get up to $69,000 into a qualified plan.
Nice.
Just with your regular employer. That's not even talking about if you're self-employed, the cool stuff we could do. That's just at a normal, you're a normal, I work for Apple or whoever it may be. Yeah. You have to call and make sure, though, I don't know that Apple or your company will let you put that extra in, but there are companies that will let you put the extra in.
Okay. All right. Good. Hey, that is phenomenal. I like that a lot, Daniel. So, because, if we can get into a Roth and it be tax free, and then with what you were saying, you got that compounding that's going on. Like you said, the problem is $500,000 is not depleting. Well, is that really such a problem? So now you got two buckets, right? Yeah, no, I know you're being facetious, right? But my point is, that's where the compounding is coming into play. Because now you got this bucket of 500, and then you got this other bucket of 30,000 1 year, 60,000, 120,000, et cetera, et cetera, et cetera. And over that, within a short period of time, you're pushing $1 million between both of those accounts from the 500,000. So, that's the idea, right? That so many people with real estate, they're doing their own work on real estate. They're netting maybe 5% income. And it's like, why are you doing all that work for 4 or 5%? I mean, if you sold the property, we could get you, the equivalent of 7 or 8% of income, and you're not doing any of the work. So you're actually making more money. You're actually probably making twice the amount of money because you don't have the headaches involved. and you're making more income. So that's again where the compounding comes in. But I'm just more and more convinced, Daniel, people don't care about compounding. They don't care about making more money. That's what it seems like to me. The people that I come across, no, 3 or 4% is good enough, or this is good enough. I don't want to pay somebody to, I would rather make nothing on my money or whatever I can find rather than make $100,000 and pay somebody $20,000 to help me make that $100,000. It's craziness how people think out there. But anyway, you're listening to Financial Strategies. Daniel Agemy. Today's topic is tax-free for me. If it's tax-free, it's for me. Tax-free retirement. We love to give you a paper that goes along with today's show. And what we just talked about, what you need to know about Roth conversions in 2024. Yours for free. Calling us at 800-725-7616. 800-725-7616. What you need to know about Roth conversions in 2024. It's a paper that will help educate you and prime you for how to do it and how, so that you can at least know what questions to ask for how to make that happen. So you listen to Financial Strategies today, and you're Daniel Agemy, because people don't know what people don't know. Daniel, as we look at this further, we've been talking about, tax diversification, different kinds of taxes, pre-tax, after-tax, free, tax deferred, the lie about Roths and about conversions, contributions. We talked a little bit about Roth strategies, the rich man's Roth, where it's another asset class. Let's talk a little bit about that, right? It's for the conservative-minded person because it's not invested in the stock market. You're still getting growth depending upon maybe it's 3, 4, 5% tax-free, maybe it's 6% tax-free growth, which if you're getting a 5% tax-free growth, you have to make 8% at the bank to net the same after paying the taxes on that. So that's huge.
Right. Right. So let's talk about who this typically works well for. Okay, great. And comes to mind, I say 3 types of people. There's 3 types of people this works really well for, and you may change that 3. One is it works really good for somebody who wants an emergency fund, right? Mm-hmm. The type of person who just wants an emergency fund. They believe that they need to have this pool of money for emergencies. Mm-hmm. And what do you do with it? You could put it in a money market fund. That's an option now. That hasn't been an option for the last, 10 years? Yep. So here's a way where you can put your emergency fund in a safe asset class. Right. And it will grow for you tax-free, compounds, and it gives you other benefits on top of the emergency fund. That's the difficulty with having an emergency fund, is it's not doing much for you. You need an emergency fund, but it's not doing anything for you. This, you have the emergency fund, but it gives you more than just the growth of the assets, right? Right. You got the tax deferred nature. Sometimes there's some lookalike long-term care benefits on it. There's death benefit associated with it, and there can be some other things. The next type of person is for kind of like that real estate minded person, or somebody who's making a lot of money. It could be from real estate or it could just be from work. And you want to pack money away for savings for your retirement, and you don't know exactly, you're maxing out your 401k, you're maxing out your retirement savings, and you want to pack some money away, and you want the diversification from stocks, from real estate. That's the next type of person that I see this working really good for, because there's no limit how much money you can put into it. You have to design it in a way to fit the amount of money that you're putting in it so you get all the tax benefits. But once you design it properly, you can put that much money in. And then the third type of person is someone who wants to have a permission slip to spend their assets, right? You want an inheritance, you want to give your kids, you want to pass on a legacy, but you also want to enjoy the assets that you've built up. And so those are really the 3 types of people that I see these things working for the best. What do you say, AAA?
Yeah, I agree. I agree with that. And, because we're talking about the tax-free nature, it's all based upon the tax-free aspect of it. So whether it's a 4th person that wants tax-free money, or it's just the the wrapper that the whole thing is in, either way of looking at it. So I agree, Daniel, that's beautiful. And I chuckled with that because, it's been a while since I remembered and thought about that permission slip aspect. So indeed, that's a great one. And I love it for emergency money because people need to have emergency money. Typically they have $50, $60, $70,000 sitting in the bank for emergency money, no nothing, when it's going to be leveraged with this upon death for long-term care purposes or whatever, going to work a lot harder.
And a lot of people, we've had to fight some people. We've had to fight some of our clients on this, that you need an emergency fund. We call it a foundation of your assets that you can tap at any time, because people will get in this mindset, well, markets only go up. And they'll say, my emergency fund can be in the market. The problem is when the market goes down is when you need the money.
Right.
It's not, who cares if it earned 10% for 10 years if it's down 70% when you need the money. Right?
Yeah,
are you going to sell your asset when it's down 70% because you got to pay rent or whatever, right? So some people get maybe dogmatic or they get closed-minded and they think, well, I don't need safe money, or that doesn't grow enough for me. 5% or 6% is not enough for me because markets do 9%. On your emergency fund?
But many times it's taxable too. And so that's not giving you much more return with a whole lot more risk than this thing. So yeah, you got it.
So it's fitting these things together in the proper way, but it's a good, like you said, the emergency fund is a good foundation that gives you a lot of opportunity. That's why a lot of real estate people like these kinds of things, because they can turn themselves into their own banker. And when they go buy the next property, they got a big pile of cash. Or if everything falls apart and there's good deals, you could pick up stocks, real estate, classic cars, whatever you'd like to buy with it. There's not a lot of restrictions.
Right. It's very synergistic as a part of portfolio that works very nicely with the investment diversification as well as the tax diversification. And then the third kind of diversification is strategy diversification, which is not for today. But you've been listening to Financial Strategies. Daniel Agemy. We got to take a break here. We'll be back in a moment. But before we do, we would like to give you the book called Smart Retirement by Matt Segula. It's about a 100-page book. Nice, easy read book. It talks about what Daniel was just talking about, be able to make an emergency fund for people, be able to be a permission slip to spend all your money. It's a great concept. Doesn't work for everybody, but it's a great concept we want to open your mind to. And you can have that book for free for the next 5 first-time callers at 800-725-7616. 800-725-7616 for your free copy of Smart Retirement, Strategic Movement Around Retirement Taxation. And so call now.
The biggest mistake retirees make is not switching from the growth model to the income model. Good retirement plan is having enough income to last the rest of your life. Any problem in retirement, it can be solved with income. The biggest concern that retirees have is running out of money. The second biggest concern is that they want to grow their money so that they don't run out of money. And they think it's synonymous when it's not necessarily the case. People don't know what they don't know. And they're not going to know unless somebody tells them. People think that the only thing that they can do to grow their money is by investing for growth in the stock market. And it's very much a herd mentality. But you can only get growth when the market goes up. When they invest for income, they're able to get money no matter what happens. I'm Andrew Agemy, founder and CEO of Agemy Financial Strategies. We've been helping people enjoy stress-free retirement for over 30 years.
This is Financial Strategies with Andrew and Daniel Agemy.
So Daniel, when I was in college, as a freshman in college, and I joined the yearbook staff, and they didn't have a camera. I wanted to be the photographer for the yearbook. And so we didn't have a camera. And, back then, good camera is going to be like, I don't know, $300 or $400, which was a lot of money, 40 years ago or 45 years ago, whatever. And so I called somebody up near and dear to me, and I said, hey, how would you like a donation, a taxable donation, by giving a camera to this college? And he taught me a very good lesson, because he said, Andrew, you don't give money for the donation, for the tax donation. You give it because you want to give it and because of the need. I'm Andrew Agemy.
And I'm Daniel Agemy. And you're listening to Financial Strategies. Today we're talking about if it's tax-free, it's for me. And AAA, that's a very good point.
Right. I talk to a lot of people and, clients and whatnot and ask them, if they give to organizations and whatnot. And a lot of times they'll say, I just give a little bit, a few $100s a year, a couple thousand a year or something like that. But then there's people that give tens of thousands of dollars a year to organizations because they believe in the cause and because they're charitable minded. And for those people, they have an option to be able to take money right out of their 401ks, especially when they turn 70 and a half. They can give money to organizations directly out of their IRAs. It's called qualified charitable donation, right out of their IRAs directly to the organizations, and it doesn't hit their tax return, basically. Yeah, it mentions it on the tax return, but there's nothing associated with it. So it doesn't affect, if you hit certain limits of income, you have to pay more money, more premium for your Medicare insurance. It's not going to affect that. So if you took your RMD at RMD age and then put it in your bank account and then, gave, $20,000, $30,000 to $40,000, $50,000 to various organizations, it's going to be on your tax return and you're not going to get full benefit of that. And you're going to pay more money for your Medicare premium probably. Whereas if it went straight out of the IRA directly to the organization, a qualified charitable donation or distribution, it does not affect those things. And then if you do it that way, it'll still allow you to take the standard deduction of $25,000 to $30,000 a year. Whereas if you did it through your tax return like that, you're going to be giving up some money. Now, how many financial advisors are going to tell you that? Not a lot, right? They're not going to explain it that way. So hopefully, if you're listening in our listening audience, that's a way, if you're charitable minded, that you're going to be able to get a much bigger tax break than you normally would by doing it the old fashioned way.
Yeah, it's a wonderful thing. When those huge standard deductions came in, that created a problem for people who were charitable minded. Right. I mean, as you said, you're not doing it for the deduction, but this allows you to get both. You can get that huge standard deduction, so that comes off your taxes right away. And we've seen a lot of people do it this way, and it allows them to do a Roth conversion as well. Right. With that money that they would have been paying on the standard deduction. So it's you can do a lot of things. It might not be huge amounts of money you're moving over, but it adds up. If you can do 20, if you can do 30 each year and move it over, it makes a big difference.
We have a lot of people who tithe to the church, and they'll give $10,000 or $12,000 or $15,000 to the church. And if they do it from their IRA, they get to deduct that money goes and basically is deducting it from their taxes. Then they still get the $30,000 standard deduction on top of that, as opposed to, before we have many people, my siblings and all kinds of people that they give it, that they weren't getting any kind of help from that standpoint, but now they are. So people give up money, just like people give up return on their money. They'll say, I'm happy with 3 or 4% instead of making 5 or 6%. And, they know the bankers are making 5 or 6%, but they're only giving them 3 or 4%. So somebody's making money on that money. So why don't you make money on that money and then give it to the church? Give it to the Lord's work. Give it to your alma mater. Give it to somebody else that you want to give it to instead of the greedy bankers.
That is one of the most egregious things that we see, that people will be like, how much money did you say in the bank? You said you talked to somebody that had like 1.4 million in just cash sitting in the bank. Yeah, right. And it's, if you don't want the money, generate the $80,000 off of that and give it to an orphanage, right? Dear to give God's it to heart, a church, orphans and widows. Give it to somebody that's taking care of people. Like, if you really don't care, because JP Morgan or there's some banker or there's some insurance company that's making that 80 grand and they're already probably worth $25 million anyways. They're probably worth, maybe more than, maybe they're making $25 million a year, and you're donating to their pocketbook when you could be earning that yourself and then choosing who you donate it to.
Right.
One thing, AAA, or you could pay for your grandkids' college, or you could spend it for yours, or whatever, anything.
Right.
But one thing on the charitable donations, I don't think you mentioned, was you need to be 70 years old or older to qualify.
70 and a half.
70 and a half or older to qualify for making those donations out of your IRA to the charity tax-free.
Right. Right. And then, there's charitable donation trusts, there's donor advisor accounts that people can use. Depending upon your background, how much money you make, you can start your own foundation, your own nonprofit that you can put the money in, get the tax break, and then give it to wherever you want. So there's all kinds of things that can be done.
Those can really help people who just sold a business, or people who have a lot of money and they're not sure what to do. And we don't have time to get into those today. But if you are charitable minded and you have a bunch of money you're not sure what to do with, or you just sold a business and you're not sure what with the taxes, those are conversations we can have with people to talk about those more specifically. Yeah,
or you work for, if you're charitable minded, you work for an organization they give you stock, and the stock has appreciated greatly. You can give that to the the charity without, and the charity's not going to be taxed on it, and you don't pay tax on it, so it's a option. But again, you have to be charitable minded. You're not doing it for the tax. That's not the reason for the tax deduction. You got to do it because you want to do it, because you feel led to do it from that standpoint. But you're listening to Financial Strategies. Daniel Agemy. Today's topic is, if it's tax-free, it's for me. Tax-free retirement. And we've been talking about a lot of different things, and we have a paper to go along with today's show that is helpful, and it's actually on what we just talked about, how to give and receive charitable contributions. So this paper will be able to help you to be able to understand more what Daniel and I are talking about, get into a little bit more of the nitty-gritty on that front. It's only about 3 pages long. It's yours for free by calling us at 800-725-7616. 800-725-7616 for your free copy, How to Give and Receive Charitable Contributions, called Qualified Charitable Donations, QCDs. Call now, 800-725-7616. You're listening to Financial Strategies. Then you're Daniel Agemy, because people don't know what people don't know. And if it's tax-free, it's for me. Daniel, we have just a few minutes left, right? And I think we've hit a lot. Well, we haven't hit the solo 401ks for people, or solo Roth 401ks for people who are self-employed. You want to talk a little bit about that?
These are one of the maybe best kept secrets, because a lot of people have side hustles. This doesn't have to be your main job, and you can put money into a solo 401k. And what a solo 401k means, you own the business. It's only owner owned. Okay. So you can have part-time employees, but it's best if it's just you and your spouse, you and other owners, and you can set one of these things up. And you can put, if you're over in 2024, if you're over 50, you can get around $69,000 into this thing.
Wow.
We won't go through down how the exact breakdowns work, but that's a lot of money you can pump into one of these things. And so
I think we did a show on that people can go back and listen to that show that can tell more. But so if it was solo 401k or something.
Yeah. So if you just want to if you want it easy, and you want to put, say, $20,000 into a Roth, or $24,000 into a Roth, instead of $7,000 that you would do if you were contributing to just a regular individual Roth IRA, you open one of these if you have a business, and you can pack that in. So you and your spouse can do it, or you and your other business owner can do it. So where these work well is if you're only self-employed, it works really good. If you have a side hustle. So one thing people don't know a lot about 401ks is a lot of times why you don't have great options inside of a 401k at the company you work for is because they're trying to become sue-proof. So if they allow you to invest in certain things, they are liable, and you can sue them if it didn't do well. So what they do is there's certain funds that the government said these are good, and there's usually like target date funds or things like that. So the 401k company at your work will set this up and they'll put these investments that the government says that these are sue proof. And they'll put those in there. It's not really in your best interest, but what it will do is the government said it's in your best interest, so it makes them sue proof. So it's not going to generate the type of income. It's not going to generate the type of returns that you could get if you started your own, let's call it solo 401k, pack some money into that. Now, Andrew and I both like the idea of getting the match on your 401k. So if your work offers you 6%, put 6% in there, get another, that's 100% return on your money, right? Mm-hmm. That's great. But more and more companies are having no match. So if they've got no good investment options and they've got no match, there's not a lot of point to put it in there other than to save. But if you have a side hustle, if you drive for Uber, if you are a consultant on the side, if you have a hair company, if you have any of these types of things.
An Airbnb.
Airbnb, and you qualify for this. Now, this doesn't work if you're renting out real estate. It doesn't work for passive income. So if you have a house you're renting out, it won't work for that. But you can do other things where you could set up if you have a lot of real estate like that, you could set up an operating company, pay the operating company to manage your real estate properties, and that company could have a solo 401k. And that's a way you could take your rental income and get it into a Roth. So there is some pretty cool tricks you can do with these things, and not enough people in my mind are talking about them. And they're really simple. Where like you could do SEPs and you could do simples and you could do these things, but the rules are just a little bit more complicated. They're a little bit more difficult, where these you can just pack the money away pretty simply.
Right. And, a lot of financial advisors don't talk taxes because they're not allowed to. And that's why we have Connecticut Sound Tax Group, which is a tax company that we own with a CPA on staff, that we're able to help people to do holistic retirement strategies. So, well, we're running out of time.
So you can use these just to clarify, you can use these really for two reasons. If you want to pack money away so you'll never pay tax again, that's one way to do it. Or if you need to lower your tax burden right now, you do it different. But that's these kind of big numbers we're talking about, where in 2024, if you're under 50, it's up to 66,000 you could pack into these things. Or if you're over 69, you could pack into these things, 69,000 a year, depending on a few rules. But you can get a lot of money put away to either help you have tax-free or reduce your tax burden right away. Sorry for cutting you off.
No, that's fine. But I see we're out of time. And you've been listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic is, if it's tax-free, it's for me, tax-free retirement. And we have a book that we want to goes along with today's show, Smart Retirement by Matt Segula. Yours for free for the next 5 first-time callers at 800-725-7616, 800-725-7616. You listen to Financial Strategies, because people don't know what people don't know. Until next time, we're looking forward to helping you have a stress-free retirement.